All right. Welcome everyone. Well, whoa, 7 likes, guys. We didn't even start yet. Jesus. Okay. Well then. Well, welcome. Hey, what's up, guys? Hello, hello. Excited? Awesome, awesome. Welcome everyone. Welcome, welcome. Hello, hello. Wow. Seems like we're gonna have to increase our like count, goal for each stream now, since we're beginning with like 7 and nearly 10 already. So thank you guys. Let's try to get to 10 before we officially begin. How about that? Hello, hello, hello. Welcome, guys. Okay, well, let's begin. So this is going to be a very quick live stream. I mean, we have CPI tomorrow, so anything goes. It's a binary event, right? We don't really know how the markets are going to react, either to the upside or to the downside. It's either or. But we have a few things to talk about, specifically about inflation and what the Federal Reserve is going to be doing, and most likely going to be doing in the near-term future. I already told my CFO Stream Watch Report members and readers this earlier today, but I want to give you guys a little bit of an insight as well as to what I said, and kind of go over and delve into a little bit about the bond markets and what they're currently telling us as we head into CPI tomorrow, and also possibly into September's FOMC meeting. Okay, so first of all, let's go over the S&P 500. So today, I mean, there's definitely FOMO buying today. That's for sure. This rally was definitely fueled by FOMO buyers, and also due to this buying that came in, this bid, we saw the price breaking above major resistance levels and just taking out all the overhead supply. In fact, we have already filled in from last week. Well, there was a circle here, but I don't know what happened to it. But we filled in 2 of the gap down areas so far, and we have 2 more left at the top here. And so there's a lot of room to run. However, the market conditions have slightly changed, so we need to be a bit cautious as we head into tomorrow, especially since the price has hit my own daily 21 SMA. So this is the first time that we have retested this daily 21 SMA after losing both the 10 and 21 SMAs simultaneously at the beginning of this year. So this is looking a little bit precarious tomorrow as we head into CPI tomorrow due to the binary event, and not just a simple inflation is going down, so we should be seeing the market continuously reacting to the upside or simply not reacting at all. It's not as simple right now, since we have a bunch of different amalgamation of different data points that are continuously going to be coming out this week, and also for the fact the market's a little bit more sensitized. I would say oversensitized right now, but sensitized to the data that we're currently getting. So especially when it comes to inflation and the overall labor market data, like jobless claims and unemployment rate, those are going to be the top data points that everyone will have their eyes on, and the markets will react to it. Now, the positive about today's run up is that the VIX has continued to get immediately crushed to the downside, and I literally last week I mentioned this. Okay, if you guys aren't part of my free market trends newsletter that is being sent out every single month, which I began to do again this month for August, you guys should understand that the reasons why we got an immediate smash back down in the volatility, right? The overall market volatility. The number one reason was that, well, we're still in a bull market, but I gave you guys a whole plethora of different reasons in the market trends newsletter itself. So make sure you guys read that if you guys have that in your inboxes, which you guys should if you guys are a subscriber to that free newsletter. But it seems pretty interesting how VIX has been crushed completely since last week after hitting a high of 65.73. There we go. And now we're right back down to the value of 18.11 at close today. Excuse me, guys. So to me, and this signifies that as long as the VIX can stay under the value of 20, we should be slowly getting out of that correctional territory that the markets have been in. And so if you can kind of look at the percentage run up so far, we have basically retraced over 50% of this negative 9.70% move down from all-time highs. And so let me actually give you guys want to be able to take a look at it. Okay, so if you go from the all-time highs today, hey, welcome guys, thank you guys for the likes there down there. Make sure you guys hit that smash that like button down below if you guys are enjoying this stream. So right there, right? So we are about 4% from the all-time highs. So basically we have recovered over half of this correctional move down, about negative 9.70%, or textbook correction percentage range, right? And if you guys forgot, the textbook percentage for a correction is from 5 to 10%. Okay, if you go over 10%, there's still a chance that the markets can recover, but we start increasing the probabilities of a potential market crash and the start of a bear market by heading closer and closer to that 20% value. So thankfully, the markets are able to pivot right at that nearly negative 10%, and we're able to now see that there has been a complete V-shaped reversal, which I also mentioned last week of the possibility of that occurring, which if you guys remember, and we have officially retraced more than 50% of this correctional move down. So again, the markets have been making higher highs, higher lows consistently. I've also mentioned that last week, and that we can potentially see a continued rapid move up higher, whether it be a low volume or not. And today we just obviously got that FOMO buying coming in as people are now realizing that the markets are going to continue to recover, and that possibly this rapid move down, and I would say about 75% of this correctional move down was just a fluke. All right, the markets was just spooked, and we're definitely still in the bull market, just judging by how we've reacted so far with this correctional with this correction and this oversold bounce. So we should continue with this V-shaped recovery. But now let me segue into tomorrow, where we're going into a binary event, an inflation data report, the CPI report, because today we got a PPI report which continued to show us that prices are stabilizing, right? Prices are moving down, and that can usually become a precursor to tomorrow's CPI inflation. So there's a possibility that we can see lower than a 3% number coming out tomorrow, if that can happen. So the possibilities are endless, is essentially what I'm trying to say here, right? And so the expectations for the CPI year over year is 3%. That's what analysts and economists are expecting. The core CPI year over year is 3.2% is what they're expecting, compared to the previous months of 3.3%. And so it seems like everything is just stepping lower and lower in a nice manner, and it's exactly what the Federal Reserve wants to see. Now, as we all know, the Federal Reserve still has that very stubborn target of 2%. Okay, now I don't know if this is going to be a mistake or not, because of the fact that they've been holding this 2% target for over 2 years, or I think it's exactly 2 years actually. And make sure, guys, to smash the like button down below for all the people who are just joining in. Let me just add that in while you guys are all joining in. Welcome, guys. Whoa, we have a lot more people coming in now. Welcome. Hello. If you guys are newcomers here, make sure you guys are subscribing as well, and of course hitting that notification bell. We are so close to 400 subs on this channel. We have grown really well for the past couple of weeks, so let's keep that going. Anyways, I'm done with that tangent. My apologies. But I'm just worried that if the Federal Reserve decides to continue to hold this 2% target, even if all the data is telling us that, you know, we most likely won't be heading to that 2% target, there is a chance that they might just say, hey, we just messed up a little bit, so we're going to change our target to 2.5%, or maybe just anything underneath 3%. Okay, they might just say that in a very sly way. They might just put that in one of their FOMC, maybe even their FOMC minutes after an FOMC meeting. Who knows, right? And that's the only problem that I see with this, the fact that they're holding this 2% target forever. They've been holding it since the initial genesis of their beginning of thinking for a 2% target, right? So, you know, that's my only concern. I don't really care if they change the target of inflation. Everyone is already expecting them to. But who knows, right? Once we get our first official rate cut in September, which I correctly predicted that of a Q3 rate cut last year in 2023 in August, right? I said this in August. So if you guys remember that, make sure you guys smash that like button down below. So I literally said either right before Q3 or during Q3 is when we will get our official rate cut, our first rate cut. And guess what? We're getting it in September. Okay, and that is the last month of Q3 or during Q3, right? Close enough, right? So, you know, people have asked me how did I know this, right? Well, it's just kind of reading, a lot of reading, and also a mixture of gut feeling as well. Okay, so I'll just let you guys know that. All right, but. And of course, along with gut feeling was a little bit of luck. So tomorrow, what you guys need to be looking out for now on SPY specifically, let me give you guys the levels. Don't leave just yet. Okay, let me give you guys the levels. I know I told you guys that this is going to be a short stream because, again, there really isn't much to talk about, especially with CPI tomorrow. But for the levels tomorrow, we have officially retested my 542.50 level, which was a huge level of support back in late June, all the way up into the first few days of July. And so this is going to be a pretty heavy area of supply. Why? Because first of all, we have hit and closed slightly over the daily 21 SMA, but the daily 50 SMA is now most likely going to start flatlining right above this 542.50 level. Plus, let me just highlight using this circle. This is exactly where the buyers failed on August 1st. Right? Yes, we closed right over 542.50, but the very next day, August 2nd, the buyers completely failed this 542.50, and we saw a huge rise in volatility, and we saw a large push lower by sellers once the price broke below this 542.50. And so this can become a large area, a large area contest between buyers and sellers. And if we do see, either a rapid, maybe even a gap up tomorrow, there's a chance that we can lose 542.50 tomorrow. Even if we decide to gap up, we might not be able to hold 542.50 for too long due to the fact that if we do get that gap up, we might just get an early morning sell-off, and sellers can use that momentum to come back in and continue to drag the price lower and officially put the price below 542.50. Now, this is all if and only if the price decides to gap up tomorrow on the CPI data. And again, I'm always hoping for the best. Inflation has been going down month over month. And the CPI year over year data has always been good too for the past couple of months, for most of this year. And it would be amazing to see a read of 2.9 or even just 2.8% compared to the expectations of 3.3%, which is the same data or value, or same percentage point, same percentage as the previous month's CPI YOY, okay, or year over year. So in that case, if economists and analysts are expecting to see the inflation, not silent, but just to not move again and just completely flatline, that is not a good sign, obviously, since the Federal Reserve wants to continue to see a sustained drop in inflation numbers and obviously a complete stabilization of prices. Right? Price stability is the #1 goal right now, and the labor market is right after that goal. So with the fact that we're continuously seeing conditions that the Federal Reserve has wanted for the past 2 years, since 2022, when they began their quantitative tightening for their monetary policies and increasing rates, and obviously increasing their target for their benchmark interest rates or the federal funds rate. At this point in time, it seems like we have finally arrived to an economic cool down, which they have been wanting, because that's exactly what they want. They want a soft landing. They do not want a hard landing where we see an economic cool down turn into an economic recession, a Fed-induced recession. No one wants that. And the Federal Reserve themselves don't want that because they already made a mistake back in 2020 and 2021 when they forgot, well, not really forgot, but they did not decide to increase rates again after putting them at historical lows for way too long, right? And they had the money printer on for too long, right? The monetary policy of quantitative easing was a little bit too long. So they did not want to make another mistake again in just 3 years. So especially after a major event like the pandemic, right? 2020 pandemic, the COVID-19 pandemic and market recession and crash, economic recession. And so, they're really trying to be on their toes and really follow things data by data, right? They've told us this multiple times. And they've so far, I believe, have done a great job. The markets for sure have been reacting in that way. They've been basically telling us that the Federal Reserve has been doing a pretty good job. Okay, so now let's take a look at bond markets for this last part of the stream. Okay, so bond markets have actually gapped up today, and with overall equity markets, they ended on a positive note. And TLT here, the 20+ year Treasury bond ETF, and others like IEI, which is the 3 to 7 year Treasury bond ETF. And I don't think I've ever showed IEF before, but IEF is the 7 to 10 year Treasury bond ETF. Okay, so TLT has obviously closed on a positive note, and I always like to check how the bond markets are closing, or at the very least behaving right before a very important, mind you, binary event like the CPI data report. So this right here, even the days leading up into the CPI event, like yesterday and the day before yesterday, and even on Friday, we had this very nice pivot where I entered TLT. I believe I entered TLT on Wednesday, and then on Thursday, I think I added that. Maybe I got that wrong, but I'll check later. But so, with TLT here, we've been riding this very, very well. If you guys remember, I first alerted this TLT dip buy on July 1st, and personally for me, I got out on one of these 2 days. I believe it was this day, but it's one of these 2 days, or maybe I've sold slowly here between these 2 days. But what an amazing run, right? And so far, I will continue to believe that we will continue to run up for bonds, especially bond prices, which means that bond yields will continue to go lower. Now, people are talking about yield inversions and stuff like that. The yield curve has inverted and still been inverted and stuff like that. We don't need to go into that tonight, but if you guys want me to go into that in the future, let me know. I know everything about stuff like that, but it's not too important right now because, again, we need to focus on what comes tomorrow, okay, the CPI data. And so, again, it's something that you guys should be on the watch for, especially if you guys aren't in bonds. Bonds should continue to run up. No matter what the overall equity markets do. I literally told this to my CFO's Room Watch readers and private members of the Discord that that bonds will continue to do their own thing and will continue to diverge away from US equity markets. I think I said this like 3 weeks ago, I think near the last few weeks of July, and that's exactly what we've been doing. Okay, so it's just one of those few things where I really like to look at the overall bond markets right before a very important report. So if you guys aren't in TLT or any of the shorter term bond ETFs, treasury bond ETFs like IEI or IEF, I highly recommend you guys take a look at them, reconsider if you guys are not feeling bonds, because it's going to be very important, I believe, until the end of this year, or at the very least into the first rate cut of this year, which is next month in September's FOMC meeting. Does that make sense, guys? So, you know, for me, inflation, I think it's a very wishy-washy subject, but to me, that 2% target, I still think can be achieved at some point down the line, but with the Federal Reserve's target of 2% in, you know, I believe they're aiming for it by 2026, or I think it was late 2025. I believe one of the Federal Reserve governors or members have talked about it before. I think it was months ago. I don't quite remember, but they were saying something about the Federal Reserve members just overall agreeing that they should be arriving to that 2% target by late 2025 or around mid 2026 or something like that. I don't quite remember that. That was months ago. So, you know, for me, whether it be 2025 or 2026, you know, I don't know. I'm not too confident, but I know that they're able to do a soft landing, which can again help out with that 2% target. But if there's any indication, or if there's any other macro factors that decide to completely screw up with their 2% target, then the Federal Reserve will have to say something and change their stance on their 2% inflation target, and possibly just aim for whatever range. It just needs to be underneath 3%, right? It has to be at least close to their initial 2% target. That's what I'm assuming. That's what I think. I provide a little bit more details to my members, but you know, from a general standpoint and a perspective, I think the only thing that really worries me, like I said previously, is that you know, if they decide to, or if they're forced to change their inflation target, that's when the markets will react very negatively to their stance on their overall inflation target, right? If they're forced to do it. Okay, that's the only little caveat to our perfect little plan of, you know, cutting rates in September and possibly starting a rate cut cycle and seeing inflation come back down to the 2% target. That's the only negative caveat that we need to be looking out for that can completely shift what the Federal Reserve has been saying for the past 2 years. Does that make sense, guys? Okay, I've been talking a lot, well, the entire time I've been live here, but hopefully that makes sense, guys. Okay, so I gave you guys the levels for SPY, but again, if you guys remember, this 542.50 and this daily 50 SMA level, which closed at 542.74, which isn't that far away from this level, it's going to be a huge area of supply. There's going to be a lot of battles being fought between the buyers and the sellers, and so watch out for this level tomorrow. And if we do decide to reject at this level, we need to be looking out for the 536.50 level to hold, because this is now the line in the sand. This is quite literally the line in the sand. Okay, let me write it here. I know some of you guys were in here when I was silent. Okay, but the line in the sand level for SPY is now 536.50, which is why this level is highlighted as yellow. Let me make the other ones the regular colors. Okay, and so so let me signify which levels I'm talking about tonight. So SPY 542.50, very important, and 536.50 is now very important as well. Okay, we need to be able to hold this level. Now, QQQ, on the other hand, the line in the sand level is very simple, 450. I've mentioned this level multiple times back in May as well, 450. Okay, so you guys can't forget this level, right? And also, price never forgets levels, so you guys should not forget levels as well. Okay, so for anyone who's using QQQ or NASDAQ, make sure you guys remember that. Now for IWM, the line in the sand is 204.80, or if you guys want to round up, 205, right? This is a previous level that I talked about a lot as well, even before the breakout back in July, and also I talked about it a lot of times during this entire time we formed this wedge or this handle for this overall cup and handle, this macro cup and handle chart pattern. So 204.50 or 205 is our line in the sand for it'll come up here for IWM. Okay, now before I finish the stream here, okay, hey, 11 likes, wow, thank you guys. I need to give you guys one little shift in my thinking for IWM. Okay, so IWM hasn't been moving as much compared to the overall market leaders, which isn't a good sign, right? But it's still okay, right? For me, I'm still fine with it, right? Because that just simply means that more people are now back to the market leaders. They're very quick with their comeback. Everyone is buying the dip, right? They're seeing this V-shaped recovery, so they want to be involved in that V-shaped recovery, just like what we saw today with Nasdaq and the S&P 500, as we saw a bunch of FOMO buying coming in. Well, on the other hand, IWM didn't really move, right? It's just been moving sideways. However, okay, again, I don't think that's a bad thing, but from just the overall price action, there's something going on here with IWM. It seems like a little bit of faith has been lost, especially as we are now seeing the official signs that the overall economy is in a simple cool down, as unemployment rate is slightly ticking up higher, and the labor market is finally going the way that the Federal Reserve wants to go to, which is loosening up, right? We've had a very tight labor market that the Federal Reserve basically weren't able to crack at all for the past 2 years. And so with the cracks finally showing up and more cracks showing up, it might not be good for the overall laggards like the small and mid caps, but especially the small caps here. However, again, I still think we're still fine with Russell 2000 with our initial analysis and initial thesis for small caps. So as long as we can head into the first rate cut in September, small caps should continue to have a fairly relatively good rest of this year, a good H2 for the fiscal year of 2024. Does that make sense, guys? Good old water. Okay. So that's something that you guys should be looking out for. Okay, don't forget that, because IWM, there you go. Hey guys, I could see your guys' reactions. Thank you guys. So IWM, the only thing that's really concerning me is just the simple sideways price action, while the other market leaders, or the overall benchmark market, which is the S&P, have been seeing some rapid recoveries, right? And so far, Nasdaq and SPY have recovered and retraced 50% of the correctional move down. I don't think QQQ has just reached that yet, I think. Let me see. Oh no, almost almost. Okay, so QQQ and SPY, they're both basically retraced half of their correctional moves down, while IWM, well, I don't know what this one's doing, it's just sleeping. All right, so this is going to be very interesting as we head into the first rate cut. But again, I'm going to hold on to my initial thesis and analysis for mid and small caps as we head into the first rate cut of September. But hopefully this stream has been informative and most importantly applicable. And yeah, that is it for tonight, guys. Again, there really isn't much to talk about other than remembering the levels I've given you guys. Okay, really remember these line in the sand levels for S&P 500, for Nasdaq, and for Russell 2000. Okay, make sure you guys remember all of these 3 levels for each single index. All right, so good luck tomorrow. I'll see you guys on Thursday at the same time at 8:30 p.m. Pacific Standard Time or 11:30 p.m. Eastern Standard Time. Thank you guys so much for the likes. It really helps out with the YouTube algorithm. It'll be amazing if you guys can continue to like my streams and continue to join my streams. That's the most important part, because you guys will always be getting the most valuable and most importantly applicable information that you guys need for every single trading day, week, months, and maybe even the entire fiscal year. Have a great rest of your night, and I'll see you guys on Thursday. Thank you so much for watching.